145,000 jobs, the number to beat, you got to watch that, would be added in non-farm payrolls last month. And joining us now ahead of the data, Austin Goolsbee in the Windy City, University of Chicago Booth School of Business professor and former Council of Economic Advisors chairman. It's great to see you, my friend. Kate Moore is here, Chief Equity Strategist at BlackRock. Dave McIntosh is joining us, president of the Club for Growth, and a former U.S. congressman. And it's great to have everybody here. Yeah. You're right here. So what do you, don't tell us the number, because we're going to play the game in just a little bit.
It's hidden.
Given the various pieces of data we've seen this week, which have not all been great.
Right.
I think that's a polite.
That's a lovely kind way to say that. Mm-hmm.
What are you looking for today?
Without giving you the number.
Without giving us the number.
I'm expecting that we're going to have relatively healthy job gains in September. You know, we're not going to have as much of a hurricane effect as one might have had in previous years. Some of the stuff in GM is not necessarily going to have hit at this point. And while the data we got this week does increase the risk of downside to sort of the range, the consensus, and some of us may think,
right.
I'm sticking to the fact that the service economy and the labor market is going to remain healthy. So we still think that the risks of a recession are kind of overblown at this point, even with the weaker data we got this week. And so I don't want to sound too Pollyanna, but I'm going to try and stay a little optimistic about the print we're going to get this morning. What does
the University of Chicago think out there, Austin?
Well, look, I hope that's right, but I guess, Andrew, I got a little pit in my stomach. You know, and the market does too. I mean, you saw the reactions to some of the news. Right now, the strongest thing we got going for us is the consumer and the job market. And if either of those start to crack, I think we would be talking about a recession, and there's limited power for the Fed to respond. They got a short runway. The impact of monetary policy doesn't have the same bang for the buck it would have in normal times. So I'm a little nervous that we don't have a hurricane for the jobs numbers, but you know, some kind of storm is brewing in Washington that is probably going to divert our attention.
Joe would say you're rooting for a recession, Austin.
No, I'm absolutely not. 100% the opposite. I hope that we get a good number today. Even if we get a good number, I still think the Fed is probably going to.
Let me see your fingers, Austin. Are they crossed? Are your fingers crossed behind your back?
I'm surprised he hasn't. He hasn't worked.
I'm going to cross them double, like Mr. Spock crossing here.
I'm surprised he hasn't worked the Ukraine into his answer.
It's Ukraine, not the Ukraine.
Not the Ukraine. That's risk.
Thank you very, very much. Where do you land? Do you think we got a recession coming?
No, I don't. I think I go a little bit deeper and look at something that's hard to measure, and that's the cost of regulations, which is a direct impact on employers' decision to hire. And those have continued to be held low by the Trump administration day in and day out. It doesn't make the headlines of the papers anymore, because usually it's a tweet that's on the front pages. But I think that and the continued sort of tail effect of the tax cuts a year and a half ago will continue to allow the economy to expand, maybe not at the 3.5%, but the 2.5%, 3%. And so I think we'll see job growth in line with the average for this year.
Is there a real overhang from this trade war or not?
I think it creates uncertainty in the market, and then what you're seeing in the manufacturing side is people are adjusting their supply chains. And that can work both ways. So far, most of the consumer effect has been masked as companies like Walmart and others have absorbed the increased costs of the tariffs.
Right. Austin, I'll let you get political for a second here, which is, we were talking about this in maybe the 6 o'clock hour. Does the situation in Washington today make it more or less likely that the Chinese come to the table?
I don't think that, look, the Chinese are making the same gamble calculation that business is on its investment, which is, I think, let's sit back and see what happens in the election. I don't think they're inclined at all to come in and throw a lifeline to President Trump, if that's what you're asking.
No, I don't imagine that. The question is, does this, given all of the impeachment talk and everything else, and given all of the pressures that are on the Chinese, is President Xi saying, okay, I'm not buying soybeans, I'm not doing anything, I'm just going to watch, I'm going to get my popcorn out and just watch this and do nothing?
Yeah, that's what I think he's doing. And think of it this way. Think of it this way. If you were the Chinese and you went to the table and hot and heavy are going to try to negotiate an agreement, it's not clear that President Pence is going to even approve that agreement, and so I think he will wait.
Very clever. You want to weigh in? We got to go to a commercial.
I just wanted to go back to the sentiment thing here, which is the big question mark, I think, for a lot of risk assets. You know, if we have a deterioration in sentiment that's not just from impeachment and Brexit and the trade concerns, but also the slowdown in manufacturing and the industrial side, and if that really bleeds through to lots of different sectors instead of where it feels like it's isolated right now, then, you know, that's going to be a big question around hiring and investment. And I think it ends up having this sort of sustaining downward pressure on the economy. Right now, it's not there, but we are at that precipice. And I think the more headlines we get, weaker headlines on the data like we had this week, plus if things get ugly next week in terms of the trade negotiations, you know, I worry that everyone holds off on investing.
Okay, final word.
I think both the Chinese and the Trump administration have an incentive to come up with, I think of it as a light agreement. Don't accelerate the trade war, keep it steady, and that should have a slight positive effect on that sentiment.
Okay, we're going to have a lot more from our jobs panel, plus their predictions, the infamous famed predictions, coming up in just a moment.
So we're going to start getting jobs numbers that if you're including the public sector in the number, we're going to see big positives. But then all through the summer of next year, you're going to see huge negatives, like minus 100, minus 200,000 coming from the government. So we got to keep that in mind.
Austin, though, you know, I'm surprised that you don't have the pit in your stomach, given what Rick said, because you're looking at the wage issue, decelerating, not accelerating. How important is that to you?
I think it's pretty important. Now, that wages are steady after we've had several months where they were growing. It's not as big of a pit because hopefully this is a blip. But, I mean, I'm telling you, the thing driving this whole thing is that the GDP growth rate is slowing down. And a lot of the forecasters are now saying that they expect a one handle for the rest of the year. If we get GDP growth falling down into the ones, I think the jobs numbers are going to fall apart and the wage numbers are going to fall apart. So let's hope we don't go in that negative direction.
Dave, what do you think? Growth expectations for the rest of the year, what are yours?
You know, I think they're continuing to be strong in the 2 to 2.5%. From a political standpoint, this is very good news. The fact the unemployment rate is in an historic low, that's what most people around the country look at. And the job creation rate is averaging now at 160,000 a month. When you compare that to pre-Trump, the Obama era at 109, that's very good news that he can take to the public and say, we're going to continue to grow the economy, create jobs. And the wage, it's a slight downward trend in the direction, but it's still a positive increase rather than a decrease in average wages.
Sounds like a Goldilocks number to me. So it's you had everyone pick this apart. You had some weakness, you had some strengths in it. It still gives the Fed some room for cover to cut rates. So I think this is as close to a not too hot, not too cold reading for the market, and we saw the market react to it almost immediately.
Yeah, I totally agree on the Fed bit here. I think if we had a number that was very, very strong and then everyone had to reduce their probabilities of further Fed accommodation or mid-cycle adjustments, I think that would cause risk assets to sort of shake. But this is right in that sweet spot where we're still growing, but we're not growing so fast, and the Fed can continue on that path.
It's difficult to think about a recession, as I said before, with a 3.5% unemployment rate. I know that every economist can pick through this, and Austin probably has a pit in his stomach still because this is probably a tailwind for Trump. Wink, wink, head nod. But still, you know, at this point, it's about the economy, and for it to go this long, extended this cycle, really is a testament to how strong this overall economy probably is.
Right. It's not ending.
All right, who was trying to jump in? Was that Steve?
Yeah.
Yeah.
Yeah, I just want to say, talking about what I think it was Austin talking about earlier, I hadn't noticed this on the first go-round. A lot of the upward revision has come from government, which it's one of my pet peeves that government job counters can't count government jobs. It's always a large part of the revision. But you added 12,000 additional. It's about a third of the upward revision to the August number and all of the upward revision to the July number, whereas the July private sector was actually revised down. September was a decline from August when it came. So Austin's 100% right that you need to watch these government numbers to see how they're increasing the total number. But it's the private sector that looks like it has really stepped down. And just to sort of square that, we have been waiting to see if indeed the decline in capital investment we've seen would end up in a decline in investment in labor. And I have to say, it looks like it has. So we do have this step down right now. We do have some of the reflection of the CEO pessimism in those surveys and the CFO pessimism that we've been talking about showing up in hiring in the private sector. So that's worth chronicling there, as well as what Rick was saying about wages.
Hey, Austin, how quickly can these numbers change? How quickly would they change if we were actually seeing a turn in things?
I mean, if you go back and look at previous recessions, they could turn pretty quickly. And if a recession begins, the strongest part of the economy now is that consumer confidence and consumer spending remain strong. That can turn around very rapidly. In a space of just a couple of months, you can see big drops in consumer confidence. Now, it doesn't mean that it will happen, but that's the reason not to just say, hey, well, 135,000 a month is okay, and so it's probably going to be fine. I mean, if we got in an escalating trade war, manufacturing's already in a recession, and retail is already in a recession. And those are two pretty decent-sized chunks of the economy. So we got to count on the other stuff really kind of maintaining itself. And the rest of the world, the U.S. is still doing better than all the other advanced countries. So it's not primarily about U.S. policy, but there are just a lot of dangers out in the world that everybody should keep their eye on.
Do you think the Fed should cut rates twice this year?
I kind of do. You know, as we said on this program, Becky, I thought as the Fed was raising rates and continuously overconfident for 9 straight years, I thought it was kind of a mistake. So I think that they probably should be looking at rate cuts.
Kate, how about you?
I think it's necessary to maintain confidence for the Fed to provide continued accommodation. But I think let's see what happens to the data over the next couple months. You know, if we get to like December and, you know, ISMs have rebounded and the service sector looks strong, you know, we don't want to use all of our bullets too soon. And so, you know, our expectation is that October is on the table, but let's see how things go over the next couple months.
Dave, if you think that our growth is still here, do you think the Fed should be cutting? Are you worried about what you see?
I'm worried that they move too quickly and too steeply
on the upside,
on the other side and cutting it. But I think the pressure is there when you look at rates around the world that are negative in Europe and the low 3-month Treasury bill. So I think they will end up cutting. I just think they need to be cautious and not go too deep too quickly.
Steve, what's the next big thing we look at in the markets?
Well, I think it's the Fed coming up, and obviously China trade. We have to look at those talks. You have the Fed coming up. Those are, and then you have
minutes next week.
And then you have earnings starting. So we haven't had anything to really dig into fundamentally for this marketplace. That's why we've been enamored with everything around it.
Right.
Once we start to see that there's not an earnings recession, the Fed, China, all of this could be a tailwind. And I don't think that we're going to have the same October, November, December that we had in 2018. That seems to me what everyone's worried about.
So you don't think we're going to drop 20% in the next 3 months?
So that's good, right? That's a positive.